My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave Dubow. And have you ever wondered how to turn affordable housing investments into a multi-million-dollar portfolio? Well, today, my guest, Sergio Pejoves from West Palm Beach, Florida, in that area. He'll let us know if we're close enough. He's going to help us out because he has mastered the art of multifamily real estate investing, transforming 175 affordable housing units in Milwaukee into a career-defining transaction. Sergio, welcome to the show. Great to have you here.
Thank you. Thank you for having me on your show. I'm looking forward to discuss, every single question that you may have to your audience and help them navigate, the challenges and the opportunities at the same time when it comes to acquiring property, whether it's multifamily or portfolio or a fix and flip. I've done it all, everything in the last 20 years.
So yeah, 20 years. How did you get started, with your background? How did you get started in real estate investing?
Well, I started back in 1999. I got it started in the mortgage industry, right? Back in the subprime era. And I first was introduced to the mortgage business, through my brother. He was a mortgage broker, and I started as a junior loan officer. Then I became a loan officer, and then 2-3 years later, I became a mortgage broker. So that was just my beginnings in the mortgage industry, which I think is a very good, important component when it comes to real estate, because that's the finance aspect of real estate. And I think having that background definitely helped me, reach, great opportunities and be able to underwrite deals in the perspective of, the financing part of it, putting together a good underwriting, because that's very important. Just that's the base of making sure that, a deal is a deal. How do you know a deal is a deal unless you have some sort of understanding of underwriting? And that was a good experience to give me the strength to understand all those factors, right?
Well, I think it's interesting too, because a lot of people, they don't know that much about the financing section so much as they can go and buy the money from a hard money loan or raise the money from somewhere else. But when they're doing their numbers, I'm sure your underwriting section for the finances is a lot tighter than, say, if I was to do the underwriting on that finance, I'd be like 10%. And then that's kind of like the bucket, whereas yours is likely a lot more sophisticated. So when did you start actually investing in real estate property?
So, I started in Texas. That's how I started. Now in Florida, as you introduced myself to being in Florida, but I started in El Paso, West Texas. And I remember having a loan application. Somebody came into my office, and there was, a guy in his 30s, and he wanted to refinance one of his properties. So, while doing the loan application, I learned that he actually had more than just one or two properties. He owned like around 35 properties, all single family rental homes. And I said to him, hey, why instead of refinancing, I may buy it from you. And he's like, well, if you give me, X, Y, Z for it, I'll sell it to you. There's already a tenant in place. He's been living there for 2 years. He's a very strong tenant. It's a good location. And, while doing I did a quick underwriting right there, at the moment, and said, okay, well, I guess I can, make a move, and this is what I can pay. And we agree on a price, and he sold that property to me. And since I was in the mortgage industry, I was able to tailor that loan so I could leverage. I mean, back in that time, you could buy an investment property to up to 90-95% leverage. So I was able to put together my own loan, close my own loan, pay no real estate fees as far as commission goes or in his end. And I was able to leverage the whole transaction. And actually, I did the loan for myself, and we were able to get some yield on the back end, because mortgage lenders, they would be able to give you origination, but also they were able to give you a yield. So I make it a par, but I also got a yield on the back end. So I was able to close literally with no money down.
Mm-hmm.
That was my first rental property back in El Paso. I ended up buying around 3 or 4 or 5 before I moved to Houston in 2006. So that was kind of like my beginnings into real estate.
So how long was it before you started fixing your focus on sort of the multifamily side of things?
So then after those, I acquired those properties and I moved to Houston in 2006, and my idea was to open a mortgage company as well. I had it in El Paso, and then open a subsidiary, so to speak, in Houston. And then, as you all know, the market crashed, and
Mm-hmm.
so I was able to understand the importance of, okay, well, it's not about is continuing, because a lot of people continue in the mortgage industry despite that everything was against you. And sometimes it's important, I believe, to just, it's not about quitting, it's about pivoting, it's about adjusting, it's about moving to a different direction. While
Mm-hmm.
others, continue in the mortgage industry and really, dilapidated all their reserve and all the money that they make on the hike of the business. I was like, no, this is the moment for me to really focus on the other side of the coin, which is the real estate. So I had access to a lot of deals because lenders were foreclosing on property, right? Short sales and all those things. So I started buying real estate just like that, buying properties that were in a pre-foreclosure situation, short sales, just a lot of opportunities there. And I started doing some, small fixer-uppers in the suburbs of Houston. And
Mm-hmm.
that's kind of like my organic transition into larger transactions. In 2000, I did that from 2007 all the way to 2012. And I was just doing so many fixer-uppers in the suburbs of Houston that I thought, I just don't want to continue being just so transactional. I just don't want to continue doing 15 to 20, 25 transactions a year. Plus, I was doing some wholesale because some properties that didn't fit the criteria, I said, I don't want to let these deals, just go. I want to
Mm-hmm.
wholesale them. So I'll put a fee and sell the contract to a potential, buyer. And I closed a lot of transactions like that. And I opened one of my companies called Houston Flippers. And I was doing a lot of wholesale transactions. So some properties I would keep and some properties I would wholesale. But it got to a point that I wanted to really go to the big leagues. And
Mm-hmm.
instead of doing so many transactions a year, why not get into a higher end property, and maybe just instead of doing 20 to 25 transactions a year, I just do 3 to 5 or 6, high end properties. So it's just, equal amount of money or even more, but less effort on my end. So I started doing I opened a company called Project Bungalows in Houston, and I did a lot of high-end rehabs, and I specialize in bungalows,
Mm-hmm.
historic bungalows that I would just buy them, fix them up, do additions. And there were just some properties that after doing the demo, you end up with a couple of walls. There was just nothing left in the property. So
Mm-hmm.
I started to say, okay, well, there's nothing to be saved. Let's just build new. And I started doing some, new homes, Crackman homes, and that was a beautiful time from 2012 all the way to 2018 that I did those projects. Then my daughter was born, and in my head was like, okay, what happens? Really want to be more into the cash flow business. I don't want to be again too transactional.
Mm-hmm.
So in 2017, we moved to Florida because I came across a beautiful portfolio in Wisconsin. You talk about the affordable
Mm-hmm.
properties, and it really didn't matter whether it was in Texas or Wisconsin. I wasn't really moving to Wisconsin just because I'm buying something else. And
Mm-hmm.
I started getting myself educated into the multifamily aspects of the business. So that was a very, very interesting journey. It was a lot of challenges, because I bought this large portfolio from a broker, off-market transaction, and you couldn't cherry pick. It was just,
Mm-hmm.
you buy the good, the bad, and the whatever. And that was just, just trying to get my hands onto those projects. They were very challenging because they were like old property. They were, in some areas that were, very, like C, negative C or D areas. and
Mhm.
just have to come and clean and really was just a lot of work. And then COVID hit. I remember, right? 2020, COVID hit.
Mhm.
So while I was just trying to stabilize the portfolio, um, we also had the challenges of the moratorium rent, right? People would stop making payments because of COVID. And that was just put a lot of pressure to me, to the operation, because people were like, okay, well, nobody's gonna evict us. Well, might as well don't pay.
Mhm.
So, but then you have obligations, right? As an investor, as a landlord, you have obligations. You have to pay your taxes no matter what. You have to pay your insurance no matter what, right? You have to pay, make all the improvement, repairs. So it was extremely challenging. But then the moratorium ended. So a lot of all those people, they were committing, right, to make those payments at a later time, and otherwise they would be evicted. And all of a sudden, we start like getting all those back rent payments, kind of like
And
catch
did
up.
people end up paying you back, or
I
was
would
it
say,
eviction
60,
city?
65 to 70% end up paying because rent, I remember rent also went up. They
Mhm.
started to climb up. And they wanted to lock their lower rate on their leases, they needed to stay. But if you don't pay, you're gonna get evicted. So it was a lot of that kind of push. And then I changed management companies also, which it was very critical because I heard all those stories, that changing management companies in the middle of a pandemic was very, very difficult. And so I ended up changing management companies, and it was the best decision ever because they just had it was a bigger organization, and being out of state investor, you need that partner, you need that
Mhm.
person, you need that team to really help you. And that was very crucial to reset, to stabilize the portfolio and to be able to package them out and sell it. So we ended up selling it in 2021. We sold it to a large group in California, and they bought the entire portfolio. And we were at 85% occupied, which is pretty good for a single family rent portfolio.
Yeah, because you're evaluating your exit is like based on the rent rolls primarily. There's others factors, but if you were selling at like a 40% occupancy, you probably can't command the same exit price, right?
Exactly. And we were able to buy it, this is kind of like my strength for negotiation because I have a mortgage background, right? Had the strength to negotiate terms with the owner. So we use a bridge loan on one package, and then we use owner financing on another package of the same portfolio. And then I bought another portfolio from another investor, and that was a home run deal because we were able to buy around 80 homes, and I was able to leverage literally 95% financing. And that was just one of those dream deals because the whole package was paid off, was free and clear. And this seller, he was just very motivated. He was also out of state investor. And
Hmm.
he was just very motivated. And I persuaded him to go on our finance because remember that time was very challenging to get loans, very
Hmm.
challenging to get loans. So initially we had agreed to get financing, but then the terms weren't there, the leverage wasn't there. A lot of the lenders stopped lending. I'm talking about the COVID era or right before
Yeah.
the COVID era. So I was just persuade them to do owner financing, and I was able to really lock the deal with 10% down. I think we're down to, or 5% down, around to $150,000 down. And by the time we get all the rent credits and everything, I end up closing with $30,000.
Wow.
Yeah, a
So,
package that we end up selling it for 3.5.
and do
So
you think that that has a lot to do with your mortgage brokering background, just being aware of the opportunities and the networking side of things?
I think definitely I give a lot of credit to that part of my career and being able to to persuade the seller that strategy is a good strategy. Um, I didn't have any competition also, and I think that's when it comes to buying real estate. When you're buying off market, you don't have other eyes and looking at the same deal. So that was also very advantageous as a buyer. I believe that it's very important for you to try to buy property off market, deal directly with a broker relationship, keep it off market. And I think that gives you the upper hand to be able to negotiate just on a one-on-one situation versus competing with other players in the
Mhm.
market. So it was an interesting negotiations, and I was able to really uh, get owner terms. And this is the best way to, in my opinion, to structure deals because you don't have all that red tape that lenders
Well, and
make.
especially on like
Oh
portfolios and
yeah,
multifamily, like a lot of the times, maybe not in the portfolio stuff with single family, but a lot of times you see with the larger and medium-sized multifamily, that's kind of how they bought them too. So
yeah,
they're kind of aware of how it works, and now they're, 20 years later or 10 years later, they're doing the exit strategy, handing off terms to the next person so that they can get in and they can get out of the problem or whatever they foresee as a problem. Maybe they just don't want to manage it anymore or whatever. But they give
yeah.
you roughly some terms and you're able to get a few, some cash down on it. So um, when you look at the way that you acquire and implement and manage these value add assets, what would you say is, the secret sauce? What comes easy to you that other people find difficult to do?
I think it's just making just making a decision. A lot of people get caught up on getting overwhelmed, with data, with doubts, if it's going to work or it's not going to work. I think one of the biggest challenges for most investors is when it comes to decision making. And you just don't make the decision, somebody else is going to make the decision and you want to lose the deal. You also got to believe on yourself, kind of your gut feeling. Yeah, educate yourself about the deal and the market, but you make really the money when you buy it, right? You're buying it at a very low price, and there's just no way for things just to go lower than that if you're buying it right. So you have to look at all the different factors, cash flow, upside of market, where you are in relationship to other properties selling in the market. I was buying these properties in an average of $25,000 to $30,000,
Mm-hmm.
and the market was already at double. So I knew that if I would close the deal today, I could turn around and sell it tomorrow for a margin.
Because you already got that kind of equity on day one because of
Yeah,
the
built in. What is holding you back?
yeah.
Just do it. Just do it. So I
I
think
think
that,
it's always fear, fear of the unknown. And I think when you look at your background, unknown isn't very high up on the list of things that come into a deal because you're underwriting it right down to the dollars and cents on the financing side. Whereas a lot of people understand maybe the purchase and maybe the renovation, but the financing is, like I was saying earlier in the show, a little bit gray.
yeah.
So, if people want to get better on the financing side of things, what do you suggest they do?
I think that you need to understand what are your strengths and your weaknesses. In my case, I'm being blessed that I had the opportunity to know both aspects, right? The finance aspect and the real estate aspect. And, I have a very comprehensive understanding of the business. But if you lack one of those things, like let's say you have a deal, right? And, you say, oh, well, Sergio, this is, I don't have what Sergio has, right? Talk to someone, like me or somebody in your locality and say, hey, let's maybe just work together on a joint venture agreement. These are what the things that I'm gonna, put in the deal. Just put the deals, kind of like the cards on the table.
Mhm.
This is I found the deal. Maybe you can help me with the underwriting. Maybe, you can also help us on raising capital, or you can, come up with the soft cost and just kind of like trying to team up with others. Don't try to do it all together like me. But again, in my case, I had a background, so I really didn't need to consult with others. But if you are just beginning and you're just starting, just team up with others. Don't be afraid to reach out to someone that has a background and experience. And make sure you vet them because there's just a lot of a lot of gurus out there that, they're good talking, but they really don't have much track record per se.
Well, it's interesting too, because I was watching this video and the guy said the age of the solopreneur is ending because essentially you can try to do it, but you're going up against teams all day. So
Yeah,
you might as well start building your team and even the playing field, because these people that are doing more than you, that are going farther than you, it's not that they're, the quote is, if you want to go fast, go alone. If you want to go far, go together.
that's
And
so true.
so you gotta start. And I think that's where it's been really challenging for myself, because I started in a team and now I'm kind of like a little bit of on my own. And these other, real estate teams are, someone's doing the GP work, someone's doing the capital raising, someone's doing the on the ground GP work, someone's doing the management GP work. Like there's a lot of people. It's not just like, oh, I do everything and I'm everyone and I got the financing too and I used my own money. Like I don't think with today's price point and the market trends that that's really a reality for anyone. So
Yeah.
how do you see the market, let's say over the next few years? How are you preparing for it?
Well, I think that there's going to be opportunities. I
Mm-hmm.
think that right now we are seeing a decline. Actually, in the multifamily space, we're seeing a decline. Cap rates, I don't see them coming down. There's a lot of deals that have been underwritten with way more aggressive terms, and now they're trying to refinance and they're having challenges.
Mm-hmm.
So all those deals, they need to be bought up by someone. So I think that there's an opportunity there for you to come in and pick up things at a lower price versus buying it, maybe a year, 2 or 3 years ago.
Mm-hmm.
So sometimes it's a better deal not to buy nothing,
Mm-hmm.
just kind of
What
stay.
what I'm seeing, what's
But
interesting.
on the flip side, also don't get yourself locked and don't do nothing. For example, right now, because of the uncertainty in the multifamily space. So after I sold the Wisconsin portfolio, I focused myself on buying some apartment complexes, and I bought it in Florida in the Daytona area.
Mm-hmm.
But then after that, the last year and a half, I'm being focusing on luxury. I'm kind of going back into my beginnings. I wanted to take a break from, single family luxury flipping. And now I'm going back to that because, West Palm
It's
is
Florida, right? It's
Florida
Florida.
is super hot.
Well,
So,
and I think, one thing that I always notice about Florida too is that with the cost of insurance to own, buy and hold in some of these areas, that the insurance rate is like tripled and
oh, it's crazy.
times. Flipping isn't so bad. You go in,
You're getting it
move
out.
in, you get out. Someone who really wants to pay those taxes moves in, pays those insurance taxes, and you get, your piece. And Florida's a great state for that luxury feeling, because it is a place people want to go for, and the price tag is kind of irrelevant. They're like, whatever, do I love it? Okay, Florida
And
Keys, right?
And they're just like, believe it or not, it's very little that gets mortgaged down here in South Florida. Most of
Yeah.
the transactions are cash, like coming from, the north. This is not, the aftermath of COVID, right? Everybody came in an avalanche, and values have triple, double, triple, quadruple in most of the neighborhoods, again, close to the water. And you
Hmm.
may say, okay, well, this is not a COVID thing anymore. There's a lot of fundamentals when it comes to why people move down to South Florida. Taxes being very important. The political environment also contributes that.
Now it's like a migration
The
thing.
migration kind of thing. So they're just, Miami, is hotter than ever right now. And
Yeah,
there's just
12,
more
12 million
development. A
people.
lot of, companies from New York are moving their corporate headquarters down to South Florida, and all those people needs to be housed, and they are, high executive pay jobs. They are.
Mhm.
So I think that there's just definitely a lot of opportunity still here. I don't see prices going down. So again, it's about pivoting, and that's the beauty about real estate. Now you can focus on certain, like the multifamily, and nothing wrong with that. I still look at multifamily. But in the meantime, there's no opportunity there. I just don't want to buy just because I'm supposed to buy. And a lot of people get kind of like the fear of missing, and they
Well,
just
I
want to
think
buy.
that's where people lose the most money too, is they're
Yes,
buying to
rushing.
buy. They're just like, oh,
Exactly.
I gotta buy something.
Just
Well,
because
no, actually, you
the
don't.
exactly you get the pressure, you get the fear of missing out. But why not just continue keeping your eye on that, but in the meantime, be productive. And that's what I've been doing the last year and a half, just trying to focus on the luxury, here in West Palm, and it's been keeping me busy, and I'm very excited in continuing that path, while I look at opportunities also. So we underwrite deals every day. I do have a team, but is I delegate, and I think that's very important when it comes to real estate. You have your attorneys, you have your accountant, you have your analyst, you have all the people that work together as a team. And as you said, just doing it together is just not smart. Definitely not
Mm.
smart.
So what, I guess we got time for one more question really is, so what are some common pitfalls that you could tell to some new investors and how to avoid those things?
I think that a lot of new people, again, they go to all these network events. Nothing wrong, because I did it. I met
Mhm.
beautiful people that I end up partnered up with them. But there's a point to where, okay, education is important, but just don't get caught up on the education at all given times. You really have to make a decision, act, and go for it. What do you have? If you don't have the money, well, at least bring the deal.
Mhm.
You don't have the deal, at least bring, let's use your time for underwriting, study, become an expert of that. So I think that you have to bring some sort of value to the table. So if someone were to call me and say, hey, Sergio, I have this amazing deal, blah, 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 blah. I have a direct relationship with the owner. Here's a T12, here's the rent roll. I visit the property, here are the pictures, here's the video. Let's work together. And then I can make a quick assessment. It will take me probably, 10 minutes to make a decision on that deal. And it will tell you probably it will take you, I don't know, a month or so if you do it yourself. So
Mhm.
bring it to someone that has a track record, has experience, that can, kind of weed out all the bad deals, save you time, and then just work together, do a joint venture. And then maybe on your second, third, fourth deal, you have learned so much. You can now the track record in paper that you are part of that team, and you can probably do something on your own at that point. But I
Mhm.
think it's important just to understand what are your skills and then bring it to the table to others so you can work together. In the meantime, nothing better than doing fixer-uppers and
Mhm.
wholesale deals. You want cash now, because a lot of these large multifamily deals that are million dollar deals, they take time. It's not getting
Mhm.
rich tomorrow. If somebody's,
Well, even
telling you that,
you can like invest all your time in doing all the paperwork and da 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 da, and it could be 6 or 8 months and still not go through.
no, there's a lot of
Doesn't
deals
go.
that they're doing capital calls, and all of
Mhm.
all those deals, and all the people behind that deal, they work their butt off, and they're not getting any distributions. How are you gonna make a living? So
Yeah.
while you're working on those legacy deals, I call them legacy deals, and you can compound them in time. Then let's get into the flipping business. I don't know any other way to really capitalize and monetize something quick like that, getting into
Wholesaling and
wholesaling, or your locality, find up, the ugliest home in the nicest neighborhood, partner up with someone, sweat equity in 6, 7, 8 months, sell it, you make 100,000, 200,000 that you didn't have. Now you have some sort of capital, so when your multifamily deal, your legacy deal comes, you have something to offer to the table. Say, hey, I can come up with the earnest money together, risk capital. Now
yeah,
you're bringing
100
value,
grand
not just the
and bring some
deal.
other people in. Yeah.
Exactly. Now you have something else to offer, not just the deal itself, but risk capital. So
Mhm.
the more you bring to the table, the more you can expect from the deal.
Yeah, definitely. So if people want to connect with you, they want to find out more, they want to see what you're working on these days, how do they connect with you and then find out more?
Yeah, if they wanna learn more about me and do some joint ventures together, if you have the capital but you don't have the time, I'm your guy. Or you have the deal also, we can work together as a team. You visit me at Sergio Pejoves in Instagram, or visit me also on my webpage, worthavenuecapitalgroup.com. Send me a message, I'll reply to you very quick.
Awesome. Well, I really appreciate you stopping by, Sergio.
Thank you very much for having me.
No problem. Until next time, guys, we'll catch you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.